All right. All right, count that for five. All right, five, four, three, two, one.
Good Friday afternoon, everybody. I'm Jeff Hirsch, editor-in-chief of the Stock Traders Almanac and publisher of Almanac Investor Newsletter. And this is WealthWise on Biz Talk Today TV, brought to you by Crosscheck Media. We are live on YouTube and X Spaces, so hello to everyone out there live. I'm not sure why there's some music playing there, but um, maybe I didn't have my mic on for the X Spaces. How about that being an issue? Anyway. Again, Jeff Hirsch here, editor-in-chief of the Stock Traders Almanac, publisher of Almanac Investor Newsletter, and this is WealthWise on Biz Talk Today TV, brought to you by Crosscheck Media. Good Friday afternoon. We are live on YouTube and X Spaces now that I've got the microphone on on my phone. So hello out there, everyone that's live. For my latest picks and market analysis, go to stocktradersalmanac.com, click on login, and there'll be a link for a free trial. Today, my good friend Sam Stovall joins me again. He was here last on April 4th, the Friday before the final tariff tumble. And I'm looking forward to a little summer on the street chat with my friend. But here's what's on my radar. We've got some posts out there on this low volatility streak. I think that's setting up a potential summer retreat, despite a lot of the excitement in the world and in the markets, earnings and trade deals in the Middle East. Action has been rather calm. This is the 22nd day in a row of the S&P 500 not moving 1% or more on any given day at the close. But what I've put out there recently is that how these volatility streaks end matter. If they end on an up move, it's bullish. It's not hard to figure out. Ends on a down move, it's bearish. The last one was back in December of 24, and that set up a bit of weakness. It ended on a down move, and then we had a marginal new high in February, and then we all know what happened in the first quarter of this year. So also with the market being up at new highs and running kind of hot, we have this potential for a hot July market, something Yale Hirsch created or first discovered back in the old days. When the Dow is up more than 3% in July, it sets up a retreat in the fall. Better buy sometime in the August, October period, usually a little bit later, September, October. Average decline about 7%. Nothing crazy, but a potential opportunity. So August, September are the worst months of the year. Beginning of August is weak, the first 8 or 9 days. So at a glance, seasonally we're bearish. Fundamentally, we're mixed. The ultimate impact of tariffs is not really clear on inflation. Technically, we've broken out, but the Dow has not logged a high, and technicals are getting a little stretched. I think Sam will touch on that a little bit later if we get into it. So we could be due for a little period of pullback. Monetary policy wise, the Fed's not going to cut next week, and the chances for a September cut are about 60%. Sentiment is neutral. I look at investors' intelligence, advisors' sentiment. Bullish advisors about 52%, and bears and correction advisors combined about 48%. So for more details on all that stuff, go to stocktradersalmanac.com. So let's bring on my friend Sam. He's the chief investment strategist at CFRA. He's the analyst, publisher, communicator of all of CFRA's outlooks on the economy, market, and sectors. Author of the 7 Rules of Wall Street and the S&P Guide to Sector Investing. He writes the weekly Sector Watch and the investment policy reports on their Market Scope Advisor platform, which I read religiously. One of the reasons he's back on here is because I comment on how wonderful and insightful some of the stuff in there is. So we decided to go on again. He does their newsletter outlook. Before this, he was the managing director and chief investment strategist at S&P Global for 27 years. Before that, editor-in-chief at Argus. He's got an MBA of finance from NYU, bachelor's of history at Ed Muhlenberg, and he's a board member at Wise, promoting financial literacy, and he's a trustee at his alma mater, Muhlenberg. So welcome back, Sam. Thanks for coming on the show again. How you doing, buddy?
Doing great. After such a nice intro, I'll just say, hey, thanks. See you later. But
That's all you need, right?
that's right. That's right. But I
So
learned from the best. My father, your father, you, etc. So just try to build on that and give people what they need.
you do a great job, and that's the reason we're back here talking to each other this time around. I mean, there was some research that came out from the Washington Analysis, this group, but we'll get to that in a minute. Last time you were on was April 4th, the Friday before the big April 8th bottom. A lot's happened since then. What stands out the most to you and what's changed?
Well, what stands out first off is the speed with which the market fell 10%. So we had a 10% decline from the February 19th high into March. It only took 22 calendar days for that decline to occur. Normally, for declines of 10% or more, it ends up being something like 80 days. So what I found was that swift tends to equal shallow and quick recoveries. And that's exactly what we got. On April 4th, we ended up with a 90% down day, according to our Lowry associates. And they said basically it was throwing the baby out with the bathwater. I like to take a look at the percentage of the S&P sub industries, and there are 155 of them. What percent are trading above their 50 and 200-day moving averages? And on April 4th, that number had fallen to 1%. And typically, once you go below 10%, it indicates, we're getting to an oversold situation. And if it goes below 5%, it's like ringing the dinner bell, come and get it. And so on April 14th, I published a sector watch that said bottoming bearishness. Didn't write it on the 4th, but did it fairly soon thereafter. And again, what happened was history told us, well, where do we want to go? What do we want to be invested in once we do hit a bottom from a 10% decline or greater? And basically, it's a rotation from first to worst, or
Hmm.
as we say in New York, from foist to woist. Uh, basically move away from those sectors that held up the best during the market decline, usually your defensive consumer staples, healthcare, utilities, and into the groups that were beaten up the most. And in this case, it was communication services, consumer discretionary, and tech. And typically, they're the ones that lead the way out and tend to outperform even as much as a year later. So the three worst performing sectors, 10 worst performing sub industries, and that's working again this time around. So, I like to pat history on its back.
Yeah, so at the time you talked about those red flags, and I will give you some props. You were expecting a pop after that drop, and you said you realized that the coast was clear on the 14th. There was some talk about Zweig breath thrust. I know there's a Lowry's breath thrust. Was that what helped you guys realize the coast was clear? Was there some other indications?
No, I think that was the one that I can identify. I mean, I read your research, I read other people's research, Craig Johnson from Piper Sandler, et cetera.
Excellent.
And so, I am willing to steal from the best. Basically, my thought was putting all that data together with my um, percentage of sub-industry model with Lowry. Lowry is very good if you wanted to get a better feel for the short term, because as you had said, the Zweig thrust gave a good idea that, that was a pretty powerful move, both down and then subsequently up. And so that indicated that maybe we have seen the worst. So it usually takes a little while. I have yet to capture the absolute bottom on any market decline, but you feel good if you get in sooner than the pack.
Yeah, we went back in on the 17th with the Qs and the IWM, so we're pretty pleased with that. But here we are, new all-time highs, except for the Dow. Are we bracing for a pullback or buying or bailing? What are we doing here? What do you think's the most prudent course of action?
Well, I think right now that while we could end up seeing a digestion of gains, we probably still have a little further to go. And I'll say why. I mean, first off, what is causing investors to say I'm worried is that the S&P has gained almost 30% since its April 8th low. You've had every style, size, sector, and 95% of the sub-industries in the S&P 1500 post price increases. We've also recovered everything that we lost in that 19% decline from February 19th through April 8th. We've had earnings, however, almost be cut in half. Earnings growth went from 13% at the end of 2024 down to 6.8% as of June 30th, this being for the full year 2025. So that was a concern.
Is that across the board, or is there sector specifics on the earnings?
That was across the board. So the S&P itself was a 50% reduction. But in terms of sector changes, there were a variety that went from positive to negative, and that essentially every sector saw earnings growth cut. That pushed the S&P 500 PE on forward estimates to above two standard deviations from the mean, and the mean being a 20-year look back. We looked at the CNN Fear Greed Index, and it had registered extreme greed. And that usually, like the AAII Investor Sentiment Poll, is a good contrary indicator. And, as you have been talking about, we are approaching the more challenging part of the year, seasonality. July is a good month, the fourth best month since World War II for the S&P 500. But August and September have posted average declines. September has been the only month to fall more frequently than it has risen. And October, people get spooked by the market in Halloween month for good reason, because October has had about 35% more volatility based on standard deviation than the average for the 11 months of the year. So, there's a lot for investors to worry.
However, October is the best time to buy stocks.
Absolutely,
And the
absolutely.
bear killer, the bargain month, you know that. So I guess what I want to stop here for a second on the seasonality, and I appreciate you running through that. There's some great analysis there, but everybody's talking about it. Everyone was talking about it last year a lot too. Are we going to get it again? Is it possible, or is this just this speculative craze going to push right through the seasonal weak spot?
Well, I think it could end up disappointing those who are waiting for a deep sell-off anyway. Because when I look, you had been mentioning it just briefly. What is it that's causing the market to work its way higher? First off, it's the trade victories. We've had trade agreements not only with the UK and Vietnam, but recently with Japan, the Philippines, and talk is that we could have some sort of an agreement over the weekend with the EU. So I got to admit, I can't stop humming the song, Another One Bites the Dust. So I think that's been a positive. We've seen broadening participation, not only in terms of the number of stocks in the 500 that are moving above their 50 and 200-day moving averages, but the percentage of those sub-industries. We are now above the long-term average on both the 50-day, 200-day, and the combination of those two measures. So we're seeing a broadening of participation.
So
I've
go ahead.
I've also seen that, when you look to RSIs, the relative strength index, if it reaches 70, then you start to worry about being overbought. Well, only today did we end up with industrials move above 70 along with tech. And today we have seen the industrials now be one standard deviation above its mean in terms of price versus 200-day moving average. Every other sector is still within that reasonable band, even technology. So the market, the sectors are trading within that one standard deviation. Only industrials is now above that. So that's why I'm saying that I believe we could still have some more upside, because historically the market tends to advance anywhere from 7 to 10% beyond the point at which we recovered everything we lost in the prior correction. And that usually happens in the following 4 months or so before we hit another decline of 5% or more. So
You're
I
saying
would say
above the where we fell off the cliff in February.
no, the 7% to the 10% move is after we recover everything we lost. So yeah, meaning go back to where the price was on in February.
Right.
So we recouped everything we lost on June 27th. So from June 27th forward, we're only up like 2 or 3%. So I would say 6,450 to 6,600 on the S&P is probably a better range in which to think that we're likely to see the next stumble from exhaustion.
Now, my concern here, and again, I'm not bearish for this period, just a little bit, looking for some sideways, but the Trump administration has had a series of wins, not just the trade and tariff deals, but the big beautiful bill, the other legislation that went through, and of course the Middle East. Um, I just wonder what they can do for an encore. What's next? Let's say they get the EU deal over this weekend or next week or whatever. After that, it looks like we're going to enter a relatively a quiet period for news, for earnings, for everyone heading out to the Hamptons, and I know you already took your vacation, but a lot of people are going away. What other news is going to support this market, or
Right. Well, that's a good point because what happened from February through April was what I call a manufactured correction as a result of the threats of all of these tariffs, the resurgence of the commentary regarding the Smoot-Hawley tariff of 1930, the potential of a recession. I think you know as well as I do that stock bull markets don't die of old age; they die of fright, and what they're most afraid of is recession. And also, like what Paul Samuelson once said, the stock market has anticipated 9 of the last 5 recessions. So, we almost did that this time. So I think that now that we got the trade pressure out of the way, in a sense, we go back to what was driving the market prior to the trade worries, and that is fundamentals. Prices lead fundamentals. So prices led the market down. The fundamentals, the earnings growth was then sharply revised lower. Now prices are headed higher. I think we're probably going to have to see fundamentals start to improve in order for investors to remain optimistic. I think you're right that because of current valuations, because of lack of, big, beautiful catalysts to drive the market forward, that the rate of advance will probably slow. And maybe we do end up with a digestion of gains, but I question whether we go into anything deeper than a mild pullback.
what's I mean, one of the things I love about the CFRA research, and that's available to people out there, is it not? People can subscribe to that. How do they get that?
Absolutely. Well, if they go to cfraresearch.com, they can sort of kick the tires with our fundamental research called Market Scope Advisor. We offer a free trial, and that's where you can see what our analysts are saying about individual stocks. You get my weekly sector watch and investment policy notes. So it goes, in a sense, could be top down, where you are trying to get ideas, or if you have a particular question on an ETF mutual fund stock, you can pull up the answer on that. We also offer trials on our Lowry technical analysis service, so people can check that out. But I'm not that I'm trying to take money away from CFRA, but if you are a client of Schwab, of Fidelity,
Right.
of Morgan Stanley, there are a variety of companies that subscribe to CFRA research. So, it's like don't buy the newsletter if you live near a county library. You probably already get it through the taxes you pay.
So bottom line, people can get this through their brokerage account.
Yep.
Excellent. So let's run through some of that a little top down, because I love the IPC notes, and the overall outlook. I guess you kind of touched on with your another one bites the dust here, and a little more upside. But what is coming out of the Washington Analysis Group? What I mean, they had some great analysis after the big strike in Iran. What's the latest on the Middle East from them? Is there anything changing there? They were kind of concerned about it potentially boiling over, and now that Israel and the U.S. has stopped talking to Hamas, it seems quiet over there, but that
It,
concerns me.
it does. It is quiet. It's almost like, parents who are not hearing the kids in the basement. Hey, whatever you're doing, stop it. Uh, and so, yeah, if it's quiet, then it sort of indicates that something is going on, behind closed doors. So the big concern was that we would see a spike in oil prices, but that certainly has worked its way back. I think that's been very helpful in second quarter earnings beats. Washington analysis is basically focusing more on the tariff story right now, saying that across the board they had been projecting the 10% as the base. Now they think it's going to be more likely the 15 to 20% as the minimum across the board, because that's in a sense the agreements that we have been seeing. When it comes to Israel, when it comes to Iran, really things are fairly quiet. So not too much additional news coming out on that regard.
Any thoughts on the impact of the higher tariffs on inflation or economic growth? I mean, we've seen. I saw one of your projections for Q2 was like 4.5%. I forget where that was from.
Right, you're right. Yeah, Q2 GDP growth of 4.5%. That's still our forecast, and that's another reason why Fed Chair Powell is likely to be sitting on his hands at next week's FOMC meeting. Is hey, the data does not really support us cutting rates anymore, or at least um, in the near term. Maybe we'll do it in September. Action Economics, which is a group that we follow, their forecast is for a 25 basis cut in September and another one in December.
Okay. I mean, I'm seeing a little bit less on the GDP side from the Atlanta Fed GDP now. They're like at 2.4, 2.5. So I guess we'll have to see where that comes out.
But your question about inflation, and
Yeah.
yeah, I think that's we got better than expected numbers at the most recent CPI read, and we'll also see what happens with the PCE coming out next week. Our expectation is that we're probably going to continue to see a slight stair step downward in inflation going into 2026. We see Q4 Q4 core PCE at 2.9% for this year and 2.3% for 2026. So
Really?
it's taken a while in order to hit the Fed's 2.0 target. That won't happen until late 2026 at the earliest. But I think the Fed doesn't want to wait that long before cutting rates again.
So is that the big risk? Inflation, if it should tick up? I mean, I think it might tick up more next year as some of this stuff starts to impact the hard data.
I think it could be a risk because if we're forecasting it to go down, and I think a lot of others are, if the opposite occurs, then yeah, that's. I typically find that the market reacts to two things. One is under anticipated events, such as thinking that let's say the inflation will come down, and then you find out no, it doesn't, or unanticipated events. And when people then ask me, well, like what? Say, well, I'm sorry, but unanticipated events are hard to anticipate. So, those that they're the ones that hit you from the backside.
That's like the Talmudic wisdom line, yeah, few people have plans for when their assumptions are wrong.
Exactly. Now, what I would say is why the market is reacting so negatively about the possibility of the president ousting Fed Chair Powell early. Two reasons. I mean, it reminds me of early 1962 when President Kennedy was trying to tell U.S. Steel, no, I don't want you to raise rates because we're winning the battle against inflation. You're going to cause a problem, et cetera. The market tanked well ahead of the October missile crisis.
Hmm.
And it was basically because Wall Street did not like the government telling it what to do. And I think a similar situation because what the president wants the Fed to do is to be more aggressive on cutting interest rates. And I think that while if you get that, you're going to see the 10-year yield spike upwardly. That's going to cause even greater problems to servicing the debt, et cetera, make the intrinsic value of future cash flows, et cetera, worth less. And I think that would wreak havoc on the market.
I mean, bottom line is the Fed can't really move the long end of the curve. It's really only moving the short end, and the long end is what we're paying our debt on.
Right, but if we end up reducing short-term rates enough to become stimulative and to overstimulate an economy and in a sense add fuel to the inflationary fire, I think that's what would spook the bond market and trigger another decline in the stock market.
What's your take on the interaction yesterday between the president and the chairman? Any insights on that? It was interesting to say the least.
Well, I'm trying to figure out who looks worse, Trump, Powell, or Dukakis in his tank helmet. Uh, so, anytime people wear things that are not, part of their normal uniform, they would end up looking ridiculous. So, um, I just love the exchange back and forth. No, there's not three buildings. That was finished 5 years ago. So
Yeah, I think Chairman Powell held held his own. Um,
agreed, agreed.
so Lowry's technical update. Let's just, I mean, there's a lot of bullish readings that you're getting there, but there's some technicals are getting stretched. What are we getting out of your technical team there?
Well, they are indicating that while there is the possibility of a slowdown on the near term, they are saying this should not be viewed as overly worrisome. Basically, it's like what I'm saying. I'm a bull with a lowercase b, and that while there could easily be some digestion of gains, it's probably something that we should be buying into, not running from.
Yeah.
And it is more of a seasonal phenomena. Um, what I also looked at fairly recently was, what traditionally happens by month. When do we typically see the S&P fall into um, corrections, bear markets, etc. And July and September have the greatest number of pullback starts, meaning declines of 5 to 10%, and also are on the top in terms of the number of corrections that get started. So it's still certainly a possibility, but if you go back to World War II, there have only been 5 times in which we have had a correction that was then followed in the same year by another decline of 5% or more, and they were all pullbacks, not corrections. Doesn't mean that it's a guarantee we won't have it, um, but it does sort of imply that, maybe the first decline was enough, and then the second decline is, like, what's the reverse of icing on the cake?
I don't know, cake. Just cake?
Yeah, I guess so. So
Cake by the
basically,
ocean?
you get a 1-2 combination punch with the first one, and then you simply get a smack across the face with the second one. So pullbacks are certainly a possibility, but I think it would end up being relatively mild.
I agree with that. So let's talk about some of the things that look attractive right now. You are the sector man. What are some of the sectors that you think that you're seeing are most attractive right now that are overweight, and what are the ones that are concerning? You were talking about the ones that performed worst in the drop in April, the ones that performed best. But here we are up at new highs. Industrials are clearly doing a lot better than and financials as well. Is there something else, or are those the areas that we like?
Well, the three areas that were the worst performers, communication services, consumer discretionary, and tech, are up an average of 32% versus 25 to 27 for the market since April 8th. The 10 worst performing sub industries are up 35%. Independent power producers are up 75%, semiconductors up 64%. Um, Also, diversified financial services up quite strongly. We have overweight recommendations on communication services, technology, and financials. We are market weight on consumer discretionary. So I would essentially say, well, let's go to the videotape. Let's take a look at what the S&P 1500 scorecard shows in terms of sectors that should do well and then the sub-industries within them. Certainly, there are some areas that we happen to like within the consumer discretionary category, like auto parts and equipment. So if investors are a little, or people are worried about buying a new car because of the tariffs, well, then they're going to repair their existing cars. Auto parts like O'Reilly, et cetera, are areas that we think could do relatively well. casinos, no, I'm sorry, broadline retail, but that's primarily Amazon and Macy's that we think, and Walmart, I should say, that should do relatively well. If we're looking at other areas, such as in the financials, in particular, it is consumer finance like American Express that we happen to favor, investment banking and brokerage like interactive brokers, like Apollo Group, et cetera. So there are areas within financials, transaction and payment processing, we think is a good area. So we have underweight recommendations right now on healthcare, even though this group is trading one standard deviation below the long-term average in terms of the index versus its 200-day moving average. We still think that there's an awful lot of pressure likely to come out of the administration as it relates to the healthcare sector.
You have your star ratings on the stocks. You want to just tell us a little bit about how that works and maybe a couple of I mean, you mentioned a few and I appreciate that, but anything else that comes through the star ratings?
Sure. Well, STARS is a stock, it's called a stock appreciation ranking system. It's an acronym. Three is a hold. We think it'll perform in line with the market. Four is a buy, which, obviously we think will outperform the market over the coming 12 months or so. And a five-star is a strong buy. Basically, the difference between a five and a four is that we're more willing to bet our bonus on the five than we are on the four.
Mhm.
A two is a sell and a one is a strong sell. And similarly, it's those areas where what we really think that this area is a dog and it's time for us to get out. So, what I like to do is to take a look at screens. I look for those stocks that are ranked five-star or so. Look for those companies, let's say by sector, especially if we have particular sectors that we do favor. And we have stars, favorable stars in pretty much all sectors. It's just that we have fewer of them in the sectors that we recommend underweighting. So let's say you are somebody who says, well, one of these days healthcare will turn around. So what are some of the stocks that you would recommend in that category? And from that perspective, the only five-star that we have right now is AstraZeneca,
Mhm.
AZN. But we have others, in the biotech area like AbbVie and Amgen that are ranked buy but not strong buy. We have some pharmaceutical firms like Eli Lilly that we think should do relatively well. Also, looking at companies in the healthcare distribution area like Cardinal Health. So, what I do find interesting is combining both Lowry and the CFRA stars. I like to look at those companies that have good power ratings, strong power ratings, and that have three, four, or five-star recommendations by CFRA analysts. I even take it one step further and say, well, wait a minute, what about those stocks that are still trading, let's say, below their 150-day moving average, but are seeing the power rating move higher? It's almost like a great white shark that's about to breach the surface, but hasn't done that yet. Which one of those are likely to be the ones that should move forward? Unfortunately, I didn't prepare that list for you,
Any
but that's the kind of thing that I like to do.
anything in the information technology AI, area that jumps off the list in your ratings?
Well, in terms of, I mean, NVIDIA is certainly a stock within the technology area that we favor. Um, Certainly looking in, let me bear with me a second to make a couple of quick changes here. Um, I'm actually doing the searching on our Market Scope Advisor platform right now. So, if I look for stocks within the technology sector, certainly we have five stars on Advanced Micro Devices, Arista Networks, and also looking at Microsoft itself. We're still favoring Apple, even though that's one that has been sort of a laggard when it comes to the AI story. Um, but we think it's one that realizes that they do have to get on the stick, and that we're still making recommendations on. But we have it ranked 4-star, not 5-star at this point. Um, NXP Semiconductors, like NVIDIA, is ranked 4-star. So um, there are several in that area that we still favor. Yes.
I think those are a few really good picks there. I like the Microsoft, AMD, and Arista. Um, so one of the things I'm going to just ask you about one thing before we go. I don't know if you have any feel on the crypto, Bitcoin area, but everyone's talking about this whole summer of alts. And then, I'm looking at Bitcoin down a bit today. Everything's pretty red in the crypto area. And from our research, it looks like, the crypto and Bitcoin tends to track technology with some sort of, 4, 2, 3, 4x and kind of a risk on, risk off indicator. I'm wondering if seeing a little bit of selling off here in the, Bitcoin crypto area might be a little indication that we're heading into a little risk off era. People are squaring positions ahead of a big summer weekend, and maybe into the summer week period.
Well, that's certainly a possibility. I mean, I used to jokingly say when somebody said, "What do you think of Bitcoin?" My response was, "Gee, I haven't bit a coin since they took silver out of it." Uh, and in many ways, sort of like Warren Buffett, I say, well, gee, how do you value Bitcoin? It doesn't pay a dividend. It's not used in industrial or it's not used in jewelry. Since it is virtual jewelry, you'd be wearing the emperor's new clothes if you did. Um, but I think you're absolutely right that it is a reflection of risk on, risk off. Also, with the current administration pushing for more acceptance of cryptocurrency, that certainly has been helpful. We do follow Coinbase. We currently have a hold recommendation on it because the stock just has skyrocketed recently, along with the advance in Bitcoin. So we do have a 5% asset allocation recommendation to commodities. And we sort of leave it up to the investor as to whether they should be owning gold, or whether they should be, physical commodities, or whether they should be owning virtual commodities. Now, when it comes to gold, we do think that longer term there is better opportunities, but right now our thought is we probably could see a bit of digestion of gains. I'm quickly scanning to get the comment from Matt Miller, who is our gold analyst, and he said, that his year-end target is 3,500 for gold. He sees limited upside from the current spot price, remembering that it's already up almost 30% year to date. For the end of 2026, however, his target price is 4,500, which
Wow.
is consistent. If you go onto stockcharts.com, you do a point and figure chart, and then look for a target. The long-term target is about 45, 4,400 on on gold prices. So from a technical and from our fundamental analyst, long-term opportunities remain.
Love stock charts too. Hey, Sam, listen, I really appreciate you taking the time out. Great to catch up. Thanks everyone for tuning in. I'm gonna say goodbye and wish everyone a happy Friday. And again, Sam Stovall from CFRA, thanks for joining me. I'm Jeff Hirsch for WealthWise on BizTalk Today TV, available wherever you stream your podcast. It's on YouTube. We're on X Live. And for more information, go to stocktradersalmanac.com. I'm also at Almanac Investor. You can Google me and be sure to check out Sam's SFRA Market Scope research. So thanks, everybody, and have a great Friday.